Hey everybody. Nice to see everybody bright and early on a day after a night out in Las Vegas. Thank you for all coming up this early. I'm Joe Perry, and this is Matt Weller, and we are going to be speaking today all about the Forex market. We have a series of presentations that we're going to be giving from 9 to 1, and we're going to be talking about different aspects of FX. And we'll also be giving away prizes and gift cards throughout, so stick around. Maybe you could win something as well. So I'm going to start off now talking about Forex 101. Okay, thank you, Matt. The one thing about Forex is that it's available to everybody, and you don't need a lot of money to start. How many people already trade Forex? Okay, so maybe half. Good. So this might be a little bit of a refresher, but it's always good to go back to the basics. And Forex, because what's so great about it is that you don't need a lot of money to start, is that there's people from all walks of life who can get into it. And anytime you could get a community together to talk about it, it's always better than trying to do things on your own, because when you have one set of eyes looking at something, it's always more difficult to see other opportunities that are out there. So that's why we purposely arranged the tables this way, so that it's not just in the rows like in the other lecture halls, so that if you want to talk to the person next to you about something you're seeing in the market or something that's coming up, feel free to do so. We want that community. I want you to ask questions during the presentation, and don't be shy about asking. Okay, so first is Forex 101. What you need to know about the world's biggest market in order to trade. Here's our general disclaimer, just saying that I'm not offering any advice. You're just here. I'm trying to give you a learning opportunity, trying to teach you some things. I am not telling you to go out and buy XYZ. I'll send you a copy if you want the disclaimer. Okay, so here's a brief overview of what we'll be talking about. The foreign exchange markets in general, the who, what, where, and why the Forex markets exist. Then we'll talk a little bit about how to trade the FX markets. And literally, I'm going to talk about how to actually execute a Forex trade. So it's pretty basic, but I thought this was good for a beginning level course of Forex 101. After that, we'll talk a little bit about fundamental analysis, things you need to know without looking at the charts. And when we're really talking about fundamental analysis in Forex, we're talking more about macro analysis, okay? Then we'll get into the charts. Those are my favorite, technical analysis. I love trading technical analysis, but you always have to have the bigger fundamental picture when you're trading. We'll touch a little bit on some intermarket analysis correlations, looking in one market and seeing how it relates to FX and vice versa. And then I'll talk a little bit about risk management, not too much. Stick around at 11 o'clock. I'm giving another presentation that will be on risk management specifically, so this is just going to scratch the surface here. So let's get in, talk right about the foreign exchange markets. Okay, so foreign exchange markets, over $5 trillion per day in dollar currency volume are traded. Think about how much that is. $5 trillion trade a day. The U.S. bond market trades $500 billion a day. And all the stock markets in the world don't even come close to trading $5 trillion. Does anybody know what the U.S. deficit is right now? 23 trillion, right? Which is amazing when you consider that the FX market is 5, right? It's only a quarter the size of the of the national debt. It's pretty amazing. some commonly traded pairs that you look at. We use the euro dollar, which is nicknamed the euro. So I put the nicknames here as well, because a lot of times you'll hear people talking back and forth, and you might not be sure what they're talking about. But here you just have the euro dollar, the pound dollar, which nicknamed sterling, pound, and quid, dollar yen, or dollar JPY, sorry, which is the yen, dollar CHF, which is the Swissy. We have the Australian dollar versus the US dollar, which is the Aussie, the New Zealand dollar, which is nicknamed the Kiwi, the US dollar versus the Canadian dollar, which is nicknamed the Loonie, and we have Euro Yen, or Euro JPY, which is straight up just Euro Yen. And then here are other popular currencies that you don't really see people trade as much on the left side, and then some crosses on the right. Here we have the dollar Swedish krona, nicknamed Stocky, the dollar Norwegian krone, which is the Naki, the dollar Mexican peso, which some people just say Mex, and peso, and the US dollar versus the South African rand, which is nicknamed the rand. So on the right side are some cross currencies, and pretty much all of the ones that we just went over that the dollar trades against, you could see that you could also trade them against other major currency pairs. And these are the cross currencies. So an example would be euro sterling, and then euro versus whatever else we talked about. Euro yen, euro CAD, euro Aussie. Same thing with sterling. We have the pound yen, pound Aussie, pound CAD, and then whatever else against the yen. The yen is always on the right side because it's denominated, the value of it is so small right now. So it's always on the bottom of the currency, and I'll get into explaining why they're set up like this in a moment. So let's talk about who is in the FX market, who the major players are. So first is the central banks. So central banks have they have to manage their reserves. So if the value of the euro changes, let's just say it goes from 110 to 111, they're going to have to buy more euros in order to maintain the same amount. So in doing so, what they have to do is trade euros, buy and sell euros, right? So they have to do that against every currency. And that's why the market is so big. And it's because of central bank action and central bank volatility that comes into the markets when you have, especially when you have big movements and the values change of their reserves. They want to keep the same percentage that they had, but they have to buy and sell in order to keep that same percentage in place. Another thing they want to do is diversification. If there's, I'm just making this up, if something is going to happen, let's just say Brexit, we know is coming in one way or another. Central banks may not want to hold as many pounds, so they might want to diversify out of them a little bit. And if they do that, they're going to have to buy and sell. So this is where a majority of FX trading takes place, but it's not necessarily trading in a sense, less speculating. It's trading more for central banks. But the other one, large companies, okay, on the bottom right. Companies sell overseas, right? So every day, at the end of the day, they tally up their books, they see how much they made in euros, they see how much they made or lost in pounds, and at the end of the day, they have to do buy and sell. They buy and sell. And they go out to the market, they go to a bank, they get quotes, and the banks come back with a price, and these are large amounts, millions and millions of dollars. Sometimes they're done in one transaction, sometimes they're done in a couple transactions, depending on the size, depending if they want to move the market. The other thing is mergers and acquisitions. What company did I see really move the market? Bayer bought a company in the Midwest, an agricultural company. Monsanto. yes. And when that happened, the price of the euro went lower and the price of the dollar went higher because they had to come in and buy dollars, right? Now, although a lot of the market, although they were done with a lot of their trading already, the market first learned about it. So when they see a headline like that, they're going to want to come in and say, oh, there's more that has to be done. And in doing so, what they actually are doing is just, they're really behind the curve on there, and they're just moving the markets. So there may or may not be more that has to be done when there's a merger and acquisition. But if you think like Daimler Chrysler, that's another one. Any kind of overseas acquisition. And the third one we have are speculators. That's people like us in this room. People who want to trade the markets. They want to try and make some money out of the markets. They want to try to be involved. That goes from retail up to hedge funds. I used to work on a hedge fund where we traded millions and millions of dollars a day in and out of hedge funds just in order to make money. So hedge funds can move the market. High frequency trading is very popular now, where these guys come in and they jump in front of the bid and offer in some cases, depending on the size of it, and they might just try to take a pip out of the market. But now they're moving the market a little bit more. Prop traders and retail traders, as I said, such as ourselves. So another interesting fact about the Forex market is that it's open 24 hours a day, 5 days a week. So it starts in Asia, and it rolls over into the European, and it rolls over into the US, and then it goes back to the Asian session. And it's open 24 hours. There's no open, there's no close, except for Friday nights, and then it reopens early in the morning in Asia, which is Sunday night here in the US. Here's the basic hours of the Asian session. I'm going to go over these. I put in GMT because that's more of the universally known for foreign exchange. But I'm in New York. I'm from New York, so I like to talk in New York time. So it's kind of like 7 p.m. New York time to 2 a.m. is the Asian session. And the liquidity is kind of light because it's the only market center that's opened. It's only Asia at that time, right? So the liquidity is light. There's not a lot of volume going through. The spreads tend to be a little bit wider because of that reason, because there's not as many trading. And the volatility is low, okay? Unless there is an RBA statement coming out, unless there's some numbers coming out, unless there's China headline, the volatility will pick up. For the most part, these are the parameters for the Asian session. Okay, so for the European session, things really start to pick up. It's about 2 a.m. in New York till about 10 or 11 o'clock in New York. And 2 o'clock is when Germany opens. The rest of the UK is the next major center that opens at 3. So at 2 o'clock, things start moving. 3 o'clock is when they really start picking up, East Coast time, okay? The liquidity starts picking up. It's moderate to heavy later once the US comes in. The Asian session is just about closed. So you kind of have a little overlap with the Asian session, but not too much. But then New York comes in, right? And once New York comes in, things get very heavy. And especially around 8:30 data, right? When things come out. People see, a lot of times what will happen is portfolio managers will wake up at 5 in the morning. They'll look at overnight activity. They'll call their desks, and they'll have trades done in advance. And a lot of times even, you'll notice there may be some kind of reversal of activity kind of around that 6 o'clock hour, just something I've noticed personally because of New York walking in and maybe taking things the other way from the way they've been going. The spreads, they went from being wide, now they're very tight. So euro, you'll get a pip to 2 pips, and especially in and some of the other currencies that like Euro CAD, some of the crosses, they start to get tighter too. Those, if you're trading Euro CAD, it's probably during Asia, it's probably pretty wide, the spreads there. And also, the volatility starts to pick up. It's goes from medium to high. So when you have German data comes out, volatility tends to pick up. When you have UK data come out, so that's like 2 o'clock is the German data, 4 o'clock, 4:30 is the UK data. So you tend to see spikes of volatility around those times. The US comes in, things start picking up, and then it continues over into the US session. So the US session I have here is around 7 o'clock, it's more like 6 o'clock, 7 o'clock, till about 4 or 5 o'clock in the afternoon. The technical close in New York is 3 p.m. Eastern Time. In the UK, the technical close is 11. When I say technical, I just mean that that's where, if you're doing something, that's where they mark, where a lot of companies and a lot of banks and a lot of businesses will mark their books at the 3 o'clock price level. Trading generally slows down after that. Liquidity is heavy in the morning as the US data comes out, as speakers come out, and then things tend to die down in the afternoon as the US is the only session left open, right? Because UK goes home and the rest of Europe goes home, so things tend to die down. The spreads, they go from being pretty tight around the open in the US, they get wider. So you go from 1 to 2 pips to 2 to 2.5. More towards the close. And the volatility, same thing. So I was talking in the morning when US comes in, volatility is very high, and then it tends to get lower in the afternoon, unless of course there's some kind of headline or FOMC or something like that. So those are the basics of the actual market itself. Does anybody have any questions on the market? Yes. Yeah, that's actually very important because a lot of people just forget to change their clocks. Oh, sorry. He wants to know if daylight savings time has an effect on the markets because Europe actually, this year, they changed their clocks 1 week before us. We changed our clocks this past weekend here in the US. Usually it's a 2-week period. I guess I don't know why it was off this week, but a lot of people will forget. And sometimes if you want to go trade the open in Germany at 2 a.m., well, guess what? It might be 3 a.m. now, and you just completely forgot, or vice versa. So a lot of you might forget that they might have changed, and now you're like, oh, all right, it's 3 o'clock on the open, and now all of a sudden you get up at 3 o'clock to trade, and it's 2 o'clock. But, you know, the market opened at 2 o'clock, so you're an hour behind. So yes, that definitely comes into play, especially even like think about data, when the data releases are. In the UK, it's always the same time, 4:30, right? But if there's an hour shift, it's going to be 3:30. Yes, sorry. It's just easier for me to talk in those terms because GMT throws me off sometimes, especially with the time changes like we were just talking about. Okay? Okay, there's no official time. There's no official time. There's no official open, and there's no official close. So they're trading 24 hours. But generally, Asia will come in New York time around 7 o'clock p.m. on Sunday night, or every night. Okay, the U.S. generally comes in around 6 or 7 in the morning East Coast time. There's no official except for the weekends. When it closes at 5 o'clock on Friday, opens at 6 o'clock on Sunday night. Does that answer your question? Okay. So let's talk how to trade FX. This is actually the execution piece of trading FX. So currencies trade in pairs, right? So if you're trading euro dollar, euro would be the base currency, and dollars would be the quote currency. So the base currency represents the amount of the quote currency that's needed for you to get 1 unit. All right? And the second currency is the pair used to value the base currency. So basically, the one on the bottom, which is the dollar, it will cost, in this example, $1.10 to receive 1 euro. Okay? So when you see the exchange rate, that is the amount of the bottom currency needed to buy the top currency. Does that make sense? Okay. That could be kind of confusing sometimes. Who knows? I should have asked this before, but currencies trade in pips, right? Okay, pip is the same as a tick if you're trading stocks. Basis point if you're trading bonds or yields, but the smallest amount is a pip. And it stands for percentage in point. And basically what that means is, if you take it out, it's basically 1% of 1% is what you're trading. So when it goes out 4 digits, 4 decimal places to trade. And that's the reason that you need leverage, which I'll talk about in a minute, because you're trading it goes out so far in decimal points. And you go to the airport and you go to the airport to buy euros and it's like 108 at 112, right? You could sell at 108 and you could buy at 112. Well, in the markets, it's probably more like 110.03 where you could sell and 110.05 where you could buy, right? So pip is 4 places out, and it's 1/100th of 1%. So here's an example. This is how you'll see the price of a quote of a euro. You'll see 110.25, okay? So when that 25 at the end goes up to 110.32, you got to look at the last, in this case, 2 digits. Move 7 pips, right, from 25 up to 32. So that's why it's 1% of 1%, because 1% would be 2 decimal points out, and then 2 decimal points over would be another percent. Except for the dollar yen, because the value of the dollar yen currency value is so low that they only use 2 placeholders after the decimal point. So if the price goes from 108.50 to 108.65, it moves 15 pips. Okay. I'm sorry? Not in the case of yen, because it only trades 2 decimal points, not 4 decimal points. So it's only 15. Okay? It's not 1% of 1%, it's just 1%. Yes? All right. So the question is, who determined what was the base and what was the quote currency? What was that? Volume? Oh, no. Actually, I don't have an answer. I don't. That's just the way that, yeah, it really is. And it's the way that it's been quoted. When they set up the euro, they decided that the euro was going to be the top currency on the top for everything. I don't know why. Somebody decided that. Somebody in the ECB, and the world agreed to it. So that's why. Let's talk about size real quick. Now, size matters, okay? If you're trading one standard lot, you're trading $100,000 worth of currency, okay? If you're trading a micro lot, you're trading $10,000. A mini lot is $1,000. And some brokers even offer nano lots, which are $100, okay? This is the reason that you need leverage in order to trade. So for example, let's say that you're trading one standard lot. So every pip that's moved, if the dollar is the quote currency, is worth $10, okay? And that's one standard lot. So in that example, if the price moved 7 pips, it's $70. But that's for one standard lot. Of course, if you move down a little bit, if you decide that you want to trade a micro lot for $10,000, well then it wouldn't be $70. It would only be, the price of the pip would only be worth $7. And then if you traded a mini, it would only be 70 cents. So actually, that's one of the reasons that if somebody were to ask me, should I open a demo account or should I just jump right in? You know, I feel that you need that feeling to what it's like to lose money and to make money, but you could trade in such small sizes. You could trade in such small sizes that it really doesn't matter. If you want to trade a $1,000 lot, each pip is only worth 7 cents, but yet you're getting that feeling of actually doing it. So that's why I always think it's better to open an account with a small amount of money. You don't need a lot of money to do it. So here in these examples that I put up here, like I said, if the quote currency is in dollars, for a standard lot, it is $10 the value of a pip. Now for all other currencies, the value of the pip can be calculated by dividing 1/10,000 by the exchange rate. So you would take, if you're looking at dollar CAD, for example, at 131.54. So you would take 0.001 and divide it by the exchange rate, multiply it by 100,000. It's $7.60 a pip. If you're looking at dollar yen, like I was saying, it's 0.01. It's only 2 decimal points. Divided by the exchange rate, it's 9.21 per pip. And those are for where the dollar is the base currency and not the quote currency. Does everybody understand that? Any questions? Yes. Oh, they were? Let me say, micro is right here. Oh, you're right. I did reverse them. Sorry. Mini is 10,000, micro is 1,000. Sorry about that. Thank you. Okay. So a little bit about leverage and margin. Most brokers offer leverage of 50 to 1 in the US. If you go overseas, you can get as high as 200 to 1 or even higher. But the Forex market and the brokers are very regulated here in the US. So no matter who you choose at opening an account, it's regulated, and your money is, I'm not going to say it's safe, but it's probably safe because of all the restrictions that the US has on it. But it's essential when you're trading the FX market because the profits and the losses are based on such a small amount. So you think about it, when you buy a standard lot, you get control of $100,000. That's what you're controlling, okay? And each pip is worth $10. So that's why you get so much leverage, because you're trading out so many decimal points. And then the amount of margin is the amount that you need to set aside when you're placing a trade. So for example, if your broker offers you 50 to 1 leverage, the broker will lend you $50 for every $1 of capital. So if you buy $100,000 in euros, you have to put $2,000 up in margin, okay, because that would be 50 to 1. But you don't have to trade 100,000, standard lot either. It would be less. Your margin would be less. It would only be $200 if you're trading the minis. So here's what a basic order ticket looks like. Okay. This is the bid. This is where you could sell, right? And then this is the offer. This is where you could buy. And then the spread right here is 1.8. I always remember that because you sell at the bid. It's BS. You know, somebody's making money somewhere. There's a price difference there. Here you could put your order price. So if you want to put a price in, you could either set a price right there. You could put a price in right there where you would like to buy or sell, or you can just go right to market, and then you could do you could sell here or buy here. You could do it right at the market, or you could put an order price where you would like to enter the market. Here's the quantity. That is the amount of dollars that you would like to buy or sell. Here's where you would put your stop level, and you could do it in terms of price, pips, or P&L, okay? And that's where you would want to get out if you're wrong. Here's a limit order where you would want to take profits. If you are not watching the market, sometimes, you know, not everybody could sit there and watch the market all day, but if you have a level of mind, you put your limit in there, and that's where you could take profits. And you could always take partial profits. No one said you had to take profits on the full position, right? And then there's other types of orders that are more advanced, OCOs. But this is the basic ticket. So if you look at this one that we have right here, and you want to buy $10,000 of Aussie, you enter the market at 68.60. Your target is 69, where you want to get out. You have a stop at 68.50. What is the profit, loss, and margin? Anybody? Yes. Do you know the margin? In terms of dollars? Yes. 200. So there it is. So your profit right there is 40. Your loss is 10. Your margin is 200. So this is a good risk-reward trade as well. Let's talk just briefly about spot market values and roles. Spot market is the market that we trade in. It's today. We're trading today. However, those trades don't settle for 2 days. And it used to be because things took so long to happen. You know, you gotta get the tickets together, you gotta write them up, you gotta send it over to the other company, the client, the broker, whoever. Now, everything's done in an instant, but it's still T+2 because the brokers need to make money. So what happens is, even though you may be out of a position today, you still have to roll it for 2 days, which means you have to either pay if you're long or receive, if you're short, interest on the value that you had that will roll over to T+2. And those rolls take it from one value date and roll it out to the next value date. So you're still paying interest or receiving interest on that small amount. So a lot of times, depending on what you're trading, if you're trading some emerging market currencies, you have to take note of that depending on your size, because you look at the value of the interest rate in Turkey, it's like 12%. And depending on your size, those numbers could add up if you remain with a position for a while, or if you want to hold on to it. Okay, so let's talk a little bit about fundamental analysis. Go ahead. Yes. Mm-hmm. Mm-hmm. As far as execution, not necessarily. No, not as far as execution. There are, in terms of each contract is worth a specific amount, right? So you're trading contracts. You're not trading the actual currency itself. So that's different in that respect. Yes? Has the margin always been at 50 to 1? Margin used to be higher. Margin used to be a lot higher. And then there was it may have been before this, but this is what I know, is that 2015, the Swiss came in and decided to depeg the value of the Swiss from the euro, and it dropped from 120 down to 80, $1.20, or I'm sorry, 120 euros down to 0.8 euros, and it wiped out a lot of people, a lot of brokerages, and a lot of business. So they stepped in and they regulated. They said no more than 50 to 1. Other countries didn't do that. They're much more unregulated in other countries. I'm sure there was a max, and it was probably up around the same as it is now in other countries, like 200 to 1. Okay. But now it's 50 to 1, and it's pretty much standard in the US. Totally a black swan event. I was sitting there at 4:30 in the morning watching that, wondering what the hell just happened. All right, so let's talk about a little bit about fundamental analysis. So like I said before, when we talk about fundamental analysis in currencies, we're not talking about earnings. We're not talking about net income. We're not talking about sales. We're talking more about macro analysis, right? And if you're trading, you're not investing. Investing, I think of as something more than 6 months. Trading, I think, is, I use that as my difference between trading and investing. Some people look at it as smaller, but you need to know what the big picture is, right? You need to know what's going on just to get a general direction of the way that a currency may go. So, a country's economy is influenced by its monetary and fiscal policy, right? Monetary and fiscal policy help determine interest rates, and interest rates help affect the value of a country's currency, okay? So if you look at a country let's look at the Eurozone. The Eurozone has been cutting rates. The euro dropped from 130, a couple years ago down to around 110 right now, right? So just so that you have in the back of your mind that the ECB is in easing mode, you need to know that. Because that means most likely, or not most likely, that may means you want to consider being short more than you would rather be long. Right now, they're actually a little neutral right now. It'll be interesting to see what happens once Christine Lagarde comes in and she has her first meeting. But that's the reason you need to know the macro economy, okay? The central banks, they are in charge of inflation, gauging inflation, managing inflation, and or employment, right? The ECB only has one mandate. Their mandate is to control inflation. So each country is on their own to determine their unemployment level or to try to raise it or lower it, whatever they want to do. In the US, the Fed is mandated for both, right? So they want to make sure that inflation is under control and that there's enough employment in the economy, okay? Right now, unemployment is very low and inflation is low as well. But they seem to think we're neutral right now, which according to the Fed, they think we're in a good spot. I don't know if that's true. It's up to them. But members of the Fed make up the Federal Open Market Committee and the FOMC, and they're the ones that get together once a month or once every other month and determine interest rates and their growth outlooks and the dot plots. But it's always important to know who is speaking during the course of the day, because that could be headlines that may influence the market, especially if somebody's speaking who is particularly a dove, which means they want lower rates. And really? All right. and just you have to remember that. Economic data to watch, non-farm payrolls. These are some important data that you need to watch where the markets move based on these. We have non-farm payrolls, GDP, real retail sales, consumer inflation, ISM, manufacturing, and inflation data. And the inflation data itself, because we're looking, the Fed has to control both employment and inflation, can be broken down even further into PPI, CPI, core CPI, average hourly earnings, GDP deflator, and the PCE price index. The PCE price index is a favorite of the Fed that they like to look at. It's personal consumption index. So they like to see how much the Fed is willing to, how much consumers are willing to spend. So they use that as a guide. Okay. You also have to know geopolitical events, okay? U.S.-China trade war. China came out overnight tonight, right? Last night, sorry. They said something that everybody's been saying for the last couple of days, and they said, yeah, we need the U.S. to remove tariffs at a proportional rate to which we will buy more agricultural products from the U.S. It was the same thing they've been saying for the last couple of days. However, the market loved it. Stocks loved it. They spiked up overnight. I don't know why. It was just a headline. The markets react to headlines. Brexit's another one. The Hong Kong protests, we need to pay attention. USMCA, which is the United States-Mexico-Canadian agreement. Any headlines of that will affect the price of dollar MEX and dollar CAD. Turkey and Syria conflict, that's kind of been put on the back burner a little bit. Protests there's been some in Spain, Chile, the Hong Kong ones, obviously, I mentioned, and elections coming up in the UK now. And we have Argentina elections coming up as well. And tweets, right? Tweets move the markets. These are a big driver of the macro economy, whether they're true or not. It's just doesn't matter. It doesn't matter. They come out, they move the market. So it's something you have to pay attention to. I have like 3 minutes left. I want to talk about technical analysis a little bit. Technical analysis basically is based on looking at previous price patterns and price trends and looking for the same price trends that happen again in the markets. Okay? So you're looking for the same price activity continuing in today's market or in current markets. Okay? Here are some examples. Trends lines, which you draw from from lows to higher lows, or from highs to higher highs. Support and resistance areas, moving averages, which I don't think moving averages mean anything personally, but the markets pay attention to them. So because the market pays attention to them, you have to pay attention to them too. Okay, because maybe pension funds have to buy stocks if they're above the 200-day moving average. It's in their mandate, something like that. Fibonacci retracement levels, which is 38.2, 50%, and 61.8. Pattern formations, triangles, flags, pennants, wedges, and oscillators. Okay. There's also candlestick analysis. I could go over all these different types of candlesticks, but apparently I'm running a little low on time here. Some sentiment indicators. I just want to give you real quick examples of some of the things that I look at when I'm looking at a chart and I'm looking at the technical analysis. There's 5 things in this chart that make me think that CAD yen is going lower. Does anybody see anything? Yes, trend line. Yep. Fib retracement to the 38.2. There's 200-day moving average that you could barely see that comes in there. The candlestick is a shooting star, and there is horizontal resistance right there as well. Okay, there's 200-day moving average, the downward sloping trend line, the inverted hammer or shooting star, and the psychological level of 82. The market tends to halt or make decisions around round numbers. Okay, it's just the same thing as a 200-day moving average. It means nothing. The market likes to look at round numbers. And the 38.2 retracement level. And here you could see, this is what happened right after that. Price did go down lower to support, and then it reversed and went higher, and took out the top of the downward sloping trend line or triangle there. You could see right after the inverted hammer there, you could see the price did move lower. This is an example of a flag pattern. To get the target for a flag pattern, you take the length of the flagpole and you add it to the breakdown of where price broke down from. This is a descending wedge. The target of a descending wedge is a retracement of the entire wedge. And actually, so right now this is trading actually sideways. So it really hasn't moved that much. This is actually now, it's not a descending wedge, it's now a triangle formation, but it's not shown here. Let me just go through some other ones that I have here. Yield curve, I said that this is an example of a yield curve. And I was looking at this one and I was like, where did I see this pattern before? Moving down into an inverted head and shoulders and then back up to the 61.8 retracement level, okay? And that's exactly what happened. We met the target for the inverted head and shoulders. And the place that I saw this originally, which gave me the idea, was last year in WTI. In the fourth quarter, crude came off, put in inverted head and shoulders. And when I saw that inverted head and shoulders being put into place, I thought maybe they'll do the same thing. And it actually did. Okay, so I think that is all I have for this session because Matt is going to talk about intermarket analysis and correlations, and then later I'm going to talk about risk management, and those are the next few topics I'm going to talk about. So with that, I'm going to turn it over to Matt.